Thank you for coming. This is a short notice. In this presentation, I'll explain to you how the system works, meaning how we send the messages, trade messages, if you're a member, and what you can do to maximize the gains in your trade. So I'll give you some background, how I operate during the market hours and even before market hours and after market hours to prepare for the next day and then during the market hours. So trading requires preparation. So in my experience, I have seen thousands of traders, they don't prepare for the market. They don't do any homework. There's no homework done in the pre-market hours. There's no homework done after market hours. And during the market hours, they are not laser focused. They're not laser focused into what they are trying to capture or what kind of a trading candidate they're looking for. They're not laser focused. So when I'm trading during starting 6:30 Pacific, I'm very laser focused on the type of trade I'm looking for. If it doesn't appear, it doesn't appear. If it appears, it appears. So sometime 1 hour gone by or 2 hours gone by, there's no trading candidate. Also, I'm laser focused on the certain instruments, such as uh, the stocks which are suddenly getting volatile, trading in 1 million or more shares just in the first 30 minutes, trading beyond their normal range, options going crazy, whether the calls or the puts. So some kind of a news is there, some kind of a catalyst is there, which is making that symbol. Doesn't matter if it's a one letter, two letter, three, four letter. Something is going on behind it, and I expect that it will continue for next 3 days, 4 days, 5 days. The momentum can die or the action can die for a day or so or subside, but then it will regenerate, and that's where the gain comes in options or even in the stocks. This is what I learned a long time ago, like 12, 13, 14 years ago. um, Somebody, when I was a newbie and I was trying to learn everything, trying to trade everything, futures market, commodities, forex, stocks, options. So I was told uh, by my friend, he was 78 years old, very seasoned. He said, Noshi, you need to practice only few things. So I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. So he in other words, he said, forget about the futures market, forget about the commodities and forex, etc. If you cannot trade a stock, if you cannot read the market, if you cannot read the stock, you cannot trade options. And if you cannot trade stocks, you cannot trade forex, futures, commodities. There's too big of a field. So Bruce Lee helped me. Another advice what he gave me is to detect the movement of the dinosaurs. So dinosaurs are the big boys. Um, they are leaving their footprints when they are operating in the market. They are leaving their footprints, and we need to detect the footprints, whether they are operating in the dark pool or somebody is following in the retail market. But there is something going on where the retail traders can detect. So learn the technique of detecting the dinosaurs movement. So it's there every day. There is something being bought by these either millions of traders or the big boys. So something is going on in something. So um, that's where the money is. Something is going on in something. So what is going on and in what symbol? That's what we need to figure it out. So early morning, starting 6:30 a.m. Pacific, something is there always. Whether to the and another thing is both sides of the market, whether to the upside or to the downside. And especially if something is going on in not just one symbol, but a group of symbols, so the industry groups. So if 4, 5, 6, 7, 8, 10, or 15, 20 stocks in the same category, they are all tanking, such as, let's say, regional banks, or the crude oil stocks are suddenly just breaking down, or they are moving up, or the um, pharma stocks are just going crazy every day. Something is there. Now, out of all these 10, 15, 20 symbols, which one has already made its move and which one is just at the initial stage? So that is another art to figure it out. Out of all these 7, 8, 9, 10 symbols, I'm seeing which one is the best one. So another thing which I learned, there are thousands and thousands of chart patterns. I mean, you can spend whole life learning, spend buy books on Amazon, Google, PDFs, a lot of things available. You can spend whole day, YouTube, the people teaching you all kinds of things, but not everything works. So instead of mastering everything, trying to learn just few. So this is what another advice I was given: to master the key chart patterns. Look for the things which work, where the risk and reward is there, and the patterns which are consistent. So the patterns which are consistent, they are reliable, they appear quite often. It's not prudent to master something which appears once a year, because if once a year it appears and you miss it, you miss the profit. Or what if that once a year trade comes out to be a loser? So you need something which master something which is there every day. Something is there, whether to the upside and whether to the downside. So I have done some homework, and I'm constantly doing the homework of identifying which stocks. I categorize it as hardcore. So which stocks are the hardcore stocks, which stocks are the core stocks. So hardcore stocks, I that's my terminology, hardcore. I can name it something else, like Apple, Baba, Baidu, Meta. These are stocks. So I don't want to miss the move in these stocks. Then there are some core stocks which I, even though if I don't trade, but I need to know what is going on because they comprise the market. So I need to know where they are, and whether they are moving or not moving, uh, trading in a tight range. So I look at those, just to make sure that I'm not missing something, or something is not, I'm overlooking, because sometimes the Baba is not moving, or Baidu is not moving, or they're trading in a tight range. They're just going up and down in a slow motion. So I don't want to trade those, but I know they are there. So because the market is made up of those stocks. Then there are some non-core stocks such as Verizon, AT&T, GE. So those, those stocks which they may be good for dividends, but not good for trading short term or options. So they just move 20 cents, 30 cents, 40 cents. But I need to watch because they are part of the market. Then there's a small cap stocks. So there are tons of them. So I have to be very careful in which stocks, small cap stocks, have the potential, because they move 20%, 25, 30, 40, 50%. And if they have options, so small cap stock list, fundamentally, they need to be strong. So I cannot trade a small cap stock long if they are fundamentally weak. So this is where the work needs to be done from the fundamental point of view, and then apply the technical analysis. So I become a rational trader. For a short term trading, the stock can tank, and fundamentally it is still strong. So there's a news, stock is tanking, but overall the fundamentally is not that bad. But for the small cap, it has to be strong. There is some catalyst, some new product, some new market, something is there, some joint venture. something is there in the small cap, and there is a potential. So those stock, and then once I spot it, either I'm buying the shares, or if it has options, then the options, the spread, the volume. For the volume in the option volume in the small cap stocks, if even if it has 50,000 contracts in the calls, they don't mean much. I mean, they mean 50,000 contracts, but because they are 40, 50 cents, so people are buying in bulk, like 100 contracts, 200 contracts. So the volume, we have to see just not the volume, but the price of the option and the price of the stock. So don't be fooled by the number of contracts being bought in the option. They say, oh, 50,000 contracts, but 50,000 contracts, they are trading at 30 cents. So a lot of traders are buying 1,000 contracts, 2,500 compared to the option volume. It's the same option volume in the Apple stocks mean a lot than the same option volume in the small cap stock. So just need to make sure we understand that. Then I also watch indices ETF. So DIS, SPY, TQQ, QQQ, all these I need to watch because I'm trading without understanding where the market is. I am trading blindly. If I don't watch indices ETFs, I'm trading blindly. Then the semiconductors ETF, then the gold and minor and gold junior bugs, silver, gold stocks, etc. NEM, AEM, gold, all these, I have a basket of those, and they move. So when suddenly they start moving, I watch the gold futures and I watch these basket of stocks. So for the gold and silver, not one stock move is not enough. I need to see the bulk, bunch of them. Bunch of them are showing the move one way or the other. And then there is an inverse ETF. So they move against the other side of the market. So having inverse ETF in the basket, I can let's say I'm good in trading the long, only the long side. So if the market is going down, I can trade the inverse ETF. Uh, or the market is going up, I can trade the inverse ETF the other way around. So I have the separate basket for inverse ETF and just to see what is going on with the inverse ETF. So these are the baskets of stocks, and it's constantly being maintained, constantly being maintained. Some symbols get deleted, some symbols get moved, they get merged, they become inactive, or there's a momentum just die. There's no activity. So they get shuffle around just to make sure that I am following those stocks which are in the move. Now, there are so many ways to trade. There are some I listed here. So before the market even opens, so I give you the example how the trading. So there is I open the loop and then we have to close the loop. Opening the loop means before the market opens, you get ready. So there has to be a process in getting ready for the market at least 1 hour before the market opens. So for 6:30 a.m. Pacific, I wake up at 5 and I do my chores, what I need to do, the things I need to do to be mentally ready. I rate myself, how I'm feeling in mentally. Did I have a good sleep? Do I have any stress today? What other events are taking place during the day? So all that preparation goes on, meditation, coffee, shower, reading the news, seeing the pre-market action, where the market is, listening to some news. I have a team, so I need to talk to my team. So I have a quick meeting with them and see if there's any any alerts or any updates needs to send to the members, such as any stock gapping up, gapping down, need to adjust the targets, what will be the strategy, where on a daily chart where the symbol will land. So it's gapping up. So if it's gapping up in the pre-market, you can see So when the market opens, where that symbol will land, because it will gap up. It's a Tesla, or it's a snow, or it's a shop, or Airbnb, or a firm, whatever it is, or something is tanking. So where on the day chart it will land, and then based on that landing, uh, where is the support and resistance? What I'm seeing during the first 15 minutes, because it will gap up, and then I need to make sure that I don't miss out the profit if I'm already in the trade. So where is the support? Where is the resistance? And what I'm looking for, whether it's gapping above the resistance level, whether it will gap down below the support level, and if it gaps above the resistance, where what I need to look at, mentally ready to watch that symbol on a lower level chart. So all that mental rehearsal goes on. So if you're not doing this mental rehearsal during the pre-market hours, then when the market open, there are so many horses just running and so many chickens, and you have no control. So do the mental rehearsal, do the self analysis before the market open, and then when the market open, then you do the monitoring and whatever you have to do. So I do the monitoring, detail monitoring and overview monitoring and whatnot. So whether you're using the black box, some system you bought somewhere, somebody sold you the green arrow and the red arrow, or green line or red line. When green line goes here, you buy. When the red line goes there, you short. Or whether you're following some chart pattern. I do the chart pattern. I don't have a black box. I follow the chart pattern. I don't do band trading. I'm not band trading is not for me. So I'm not into trading something in the range. It goes to this line and you buy. When it goes to that line, you sell and you make 20 cents. So I'm not into that. I'm not a band trader. Trend trading, yes, I am a trend trader. So trend trading, within the trend trading, there's a lot of things. You could be trading, the trend has already been established and you're trading on a pullback. The long-term trading or the mid-term trading is there, the trend is there, and then you're trading the pullback. So you can do that if you can identify the support pullback. Or for me, most of my trading, I do the change, detecting the change in the trend. So when we detect the trend change in the trend, that's where the move, the sentiment. So sentiment change, that's where the parabolic moves come, when we detect the change in the trend, identifying the correct change in the trend, whether from the upside or to the downside, and knowing the support and resistance. So the to key or the holy grail in for me, I don't know about you, the holy grail in the success of trading is identifying the support and resistance level correctly. My trades where I lose, when I look back and I say, yeah, I missed that. I missed looking at the support level on the weekly chart, or I missed looking at the support level on a monthly chart. So that's where the or I held on to the trade when the support was broken and I held on to it, and my loss become bigger. So that's where it is. Or I did not add to my winning position when the resistance, I knew that was the resistance, and resistance was broken. Instead of adding more to the position, I exited prematurely. So these are the mistakes a trader can do. I do trade breakout. So breaking out of the resistance level, or breaking out of the day chart, and on a weekly chart, there is still a lot of potential. So when the trade is triggering, we must have some time interval. So for me, the time interval where all trades are generated are the day charts. So because that's where the thing is. So I wake up in the morning and I'm in the morning at 6:30 or 6:35, a stock gaps up. So it's not gapping up on a 30-minute chart. It's not gapping up on a 60-minute chart. It's gapping up on, not gapping up on a weekly chart. It's gapping up on a day chart. So that's where it is. So if it's gapping out on a day chart, I must look at the day chart. And I look at it. I can look at it for 3 minutes, 4 minutes, 5 minutes, and then I flip my intraday charts. I lean on a weekly chart just to see, make sure that I'm not missing out. It's not overbought on a weekly chart. It's or oversold on a weekly chart. So day chart is the one where the symbol is appearing. Then lean on a weekly chart to make sure that I'm not missing anything from the weekly point of view. And then open the intraday charts. The intraday charts could be the 2 hour chart, 60-minute chart, and then the could be the 30-minute chart. So this is the one sets of chart. And then there could be another intraday charts, which could be the 30-minute chart, and then 15-minute chart, and then the 5-minute chart. So there could be two sets of intraday uh, workspace. One is a 5 minute, 15, and then 30. And then the next higher I open, it starts with 30, maybe 60, and then a 2 hour chart. And then another one is a day chart, or it could be the 2 hour chart and the day chart, weekly chart, and the monthly chart. So it flows. And then the time interval needs to, so you have to make sure that the time intervals are also correct, meaning there are 390 minutes in during the day. So maybe you divide your bars into equal time interval. So 390 divided by whatever lower level time frame you're going to. It could be 13 minutes lower level, and there are 390 minutes. So divide that and find out your bar. So one bar is moving into next bar smoothly. So do that. I love breakdowns for the put trade. So breakdown occurs when something is happening, some bad news is there. So breakdowns are happening to those stocks. So breakdown usually give you quick results in the puts, but these breakdowns may just last 1 or 2 days, and suddenly there's a news, and then these stocks they just move up. For instance, in the regional bank stocks, they were all breaking down, and then if you don't lock your gains uh, quickly, but in 1 or 2 day move, slight positive news come and they all reversing to the upside. So breakdown needs to be quick. A gap up, I already talked. The gap up trading or gap down trading is very tricky because gapped up, the stock can gap up and then they just die. So you have to really understand that the gap is a genuine gap and it will follow through. So understand where it's gapping in the landscape of a daily chart, the weekly chart, and whether the gap is occurring above the resistance level or below the resistance level. What is doing on a lower level chart, such as 5 minute or 15 minute, where is the volume? Is the volume picking up? Is there any activity in the options? So if the stock is gapping up and the volume is not there and there's no activity in the option chain, so you may be the only one along with the market maker. So there is something called wisdom of the crowd. Most of the time the crowd is right. So just make sure that you're not going against the crowd. If you don't like what the crowd is doing, you don't have to initiate the trade because you have your own logic. You may stand out, but don't try to be a hero by being contrarian, saying, okay, this stock is gap up and I'm going to short this stock. I'm going to buy the puts. So once in a while, you may be right, but most of the time, you will turn out to be loser. So if you don't have to trade short on the gap up unless, uh, I don't know, I don't do that. So you may be master of gap up reversal, but I don't do unless the gap up occurs in a certain stock just below the resistance, and then I can clearly read the risk, knowing that this is the resistance. And I have seen it before that when the gap up occurs, such as the gap occurs and creates a candle, doji or something like that. It's like a twinkle, twinkle, little star, just a little candle gap up 4, 5 points, 6 points, 7 points, 8 points above. this normal move, and then it just sits there, and then it's breaking down, and I can clearly see my risk. Then maybe I can trade the gap up reversal. Otherwise, gap up, if I find it to the upside and I believe in it, I trade. And if I'm already in the position, so if I'm already in the position and the stock is gapping up, then my question is, what I need to do with my existing position. Do I need to continue to hold, or I need to add to the position? And if I'm adding, am I adding the stock by buying shares, or am I adding the option? And if I'm buying the option, am I adding, if I'm adding the option, am I adding the same month and the same strike? Maybe not. Maybe I need to add a different strike, a higher strike, because I'm already deep in the money with the option I have. So I don't need to add deep in the money option. Maybe I need to go 3, 4, 5 strike what I already have. Maybe I need to buy some more time for the next strike I'm buying. So I'm considering gap up as a trade, which is, let's say, a brand new trade, a brand new trade. Or I can, I'm already in the profit because of the gap up. I can create the spread. So when the gap up is occurring, I need to ask several questions. What kind of a strategy I am deploying at that time, depending on the gap up, depending on the move, depending on the remaining potential left in that trade. So gap up is very tricky. Gap down, usually the gap down occurs. You have to be careful on the gap down because the stock gaps down on some bad news, and then there's someone who and it gaps down to 50-day moving average. It gaps down to 200-day moving average. Is gapping down to some strong support, and it gaps down, and the move to the downside is like 1 hour or 2 hour, and then it hits some strong support on a weekly chart and monthly chart, and then we miss that. And somebody big boy think is a fair price to scoop all this, and they start buying it, and then suddenly your profitable trade become a loser trade. So gap down is a trickier compared to gap up. And a gap up reversal, I hardly do gap up reversal. Gap down reversal, I like to trade the gap down reversal. And so the risk is identified, and then the reversal is taking place, and you can see on a 15-minute chart the constant buying going on. So that's what I do, that gap down reversal. Intraday reversal. So intraday reversal, there's a bad news in the stock, and the stock is just tanking, and then the positive news come, and then the stock moves up, and or maybe the overall market, there was nothing wrong with that stock or the group of stock, and something happened somewhere, some news came negative, somebody spoke, maybe it was Wednesday, FOMC news or whatever it is. Somebody tweeted, and the stocks tanking, and then after 1 hour, all the stocks are reversing. So we need to identify this is if you can catch the intraday reversal, this is a quick profit. You see the gains quickly, and the risk. And for the intraday reversal, the longer you wait, the more uh, riskier the entry becomes. So for intraday reversal, you have to be bold. You have to be very bold in taking the intraday reversal trades. Moving averages breakout. So I don't do as much moving averages because uh, I don't know which moving average. If there are 1,000 traders in the room, they all have different moving averages. Simple moving average, um, exponential moving average, weighted moving average. So you name it, the moving averages is there. So mm, 8-day simple moving average, crossover, 18-day moving average. Sorry, I don't know. So, just a second. So many moving averages. So I do watch 50-day moving average or a 200-day moving average, but I don't trade the moving average breakout. Most of my trading is a chart pattern or a breakout, or gap up, gap down, reversal, etc., and support and resistance, and the change, detecting the change in the trend. So all these I'm doing. during the day, systematic way. So there is no panic. If there's something there, it's there. If not there, it's not there. Then you can apply the filters. So filters are volume filters. You need minimum of 1 million shares. Price filters, you can say, I don't want to buy options on a stock more less than $3. If I don't hardly trade $3, but if there is something, some small cap which is moving and there's a lot of options and some activity going on, maybe I do that. So there is a price filter, average true range filter. So if the stock moves $2 on any given day and it's only 1 hour and it has covered the $2, so that makes me look at that stock. So already is coming on a day chart, but then is moving beyond its range. So I need to pay attention to that. There's sudden spike in volume. The spike in volume does not uh, trigger for me to take the trade because the volumes are deceiving. So they buy something spikes up, all the retail traders just buying it and the volume spikes up and we get trapped. So I don't do that, but I do pay attention to the volume. So for the volume, the absolute volume, so if the stock trades normal 30-day average volume is, let's say, 1 million, and 3 hours gone by, so there's a 3.5 hours left and it's already trading its 30-day average volume. So I monitor that. I need to see the volume is there. I monitor the relative volume. So on a first 30 during the first 30 minutes, on average, it trades, let's say, 500,000 shares, and it's already trading 1 million. So something is going on. I need to pay attention. And especially if that's in that symbol, I have a position. So if I have a position in the trade and the volume is picking up, so I need to, if the volume is picking up and I have a position and the target is hitting, I may not sell at that target. I may have to cancel it. I have to deep dive into that trade and look at it, that whether it's a climax volume, whether the target is at the major resistance. So something is going on. How many days left in the trade, expiry? How many days I've been holding in that trade? So a lot of other variable goes into monitoring the trade. So sudden move in price, I do notice. So you can put the filters. Then the alerts. So I've set up a lot of alerts. So I get a lot of alerts on my system. So I need to pay attention. But the alerts are very, you can say, strict, because if you set up a lot of alerts, then you get tons of alerts, and a lot of them will be useless. So you need to define the alerts, meaningful alerts. So when the alert comes, it's like, I really need to pay attention to the alert. It's like when you were driving and then the cars, some ambulance moving, or the police car or fire truck, we pay attention. So something like that. Need to pay attention to the alerts which are making sense. So for instance, there is something called opening range breakout. So opening range breakout alert, if the stock during the first 30 days, not 30 days, 30 minutes made a high, let's say it opened at 100 and it traded during the first 30 minutes at 102. So if it is moving, then after 30 minutes it should go above 102. So if it goes above 102, during the first 15 minutes it made 102, high of 102, and now it's trading at 101, 101.50, 101.60. So I set the alert that, okay, this is the high made um, during the first 30 minutes, and now when it goes above, then I will take a look above the 30 minutes or above 45 minutes or above 1 hour. Then I have to pay attention to that this stock is still making an intraday high. So new intraday high made or new intraday low made. Also, I set up the alerts for new high or new low made after I initiate the trade. So if I initiated the trade at 101 and I have a position in it, then I need to know if this stock is making a new high, or is making a new low. So what is the new high registered for that day, and how many highs it has made or how many lows it has made. So I need to pay attention. Percentage up, percentage down. So a stock which you know if a stock has moved 8, 9, 10%, let's say it was a lower price stock, then and if I have a position in it, then I need to pay attention to that. This is a big percentage move, and for a small cap, maybe 25 percentage is not enough, but for a big cap, maybe 3, 4% was a big move. So I need to pay attention. Percentage down, same way. 30 volume, 30% of normal. So I pay attention. On average, if say 1 million shares move and it has already traded 300,000 and only 15 minutes gone by, I need to pay attention to that this is trading 30% of the normal volume and only 15 minutes pass. I have a set of alert for average volume, above average volume. So average volume is 1 million and is trading at 1.75 million. So I need to pay attention and see what else is going on. Any resistance or support I define, I get the alert that resistance is breaking or support is breaking or sharp reversal from resistance to the downside. So if I have a position and the resistance is hitting and the stock is pulling back, I need to pay attention to that. Maybe I need to take profit or just pay attention. Sharp reversal from support, I pay attention. Crossing moving average from below. So the major moving averages such as 50-day moving average, 200-day moving average, 20-day moving average, I pay attention to just to see what is going on when the moving average is crossing. So these are the alerts I receive. So now let's say the market opens and I'm looking for the trade. So I am monitoring my open position. I'm monitoring the markets. I'm monitoring the ETF. I'm reading some news. I am seeing which position I need to close, especially if they gapped up. And also on my secondary job is to look for the new candidate. So first take care of the open position and then find a new candidate. So let's say I found that Meta, so this is just for example's sake, I found that Meta is doing something. So doing something and I like what it's doing and adopt the process of stalking. So need to remind myself, be patient. Meta is moving, but you need to be patient and stalk it. So put that symbol into detail monitoring mode, do the stalking on a lower level chart. And so let's say the lower level chart is ready to buy. So while I'm stalking it, I'm also reading some news. I'm evaluating the option chain, which strike I will buy, which one I need to buy, whether I have an open position in it or not. So all this work goes on. And finally, let's say I decide that I need to buy Meta calls July 230. So we send out the alert to the members in a very brief subject. So just a subject or a text message saying Meta calls July 230 buying to open at $10. So this is the price at that time. It could be trading at 1020 and let's say 960 bid, 1020 ask. So in between somewhere there, and I know that it's little pullback and we get filled at 10. So the description in the email will be the stock is Meta, month is July, third Friday, strike is 230. So there's a type of 230 to 130 and the type calls. So either the calls or puts. Action, what is the action? Buying to open, suggested price $10, and always the third Friday expiry option unless I specify that it's not third Friday, it's the fourth Friday, etc. So this is a brief message goes to you. There's no story such as the RSI is here, stochastic is here. This is the P ratio. No such thing. We not concerned about P ratio and the growth and the sales. So it's based on technicals. So and fundamentally there's some news. So Meta calls July 230 buying to open at $10. So this is a short email alert goes on along with the SMS if you have provided us your email phone number. So now as a remember when you receive the alert, so all alerts are delivered instantly. So it's a real time alert, not something on Sunday night. So I don't know. I cannot send you any alert on Sunday night saying I'm looking at this one for Monday. So I don't know what will happen on Monday morning. So there's no alert on Sunday night. It's a real time during the market hours, Monday to Friday. So as soon as you receive the alert, you don't have to, if it's moving fast, it's moving fast. You may miss it, but it's not the case. It's 99% of the time is not something which is moving really fast. And then once if we don't get it, we will miss the trade. It's not like that. So you put the limit order, you get fill. If you don't get fill, so don't just walk away with your trade. You need to cancel your buy order and don't leave the buy order good till cancel. So only is for the day and especially just for a few minutes. If you don't get filled, you don't get filled, don't leave it, don't walk away, don't close your trading platform. See if you get filled. If you not get filled, then cancel it and you can reset it later. So do not buy at market price. I can sell when I sometimes I sell at the market price because the move is happening like that. But I don't buy at market price because buying at market price is not advisable. You get the mm, um, you're at the mercy of the market maker. So do not buy at market price. And when I'm sending the alert, the stock is trading in a narrow range. It is trading. It's not parabolic. It's not something going through the moon. Maybe once in a while, maybe out of 200 trades, maybe one. But so the stock is trading in a narrow range. It is trading there. And if you have not gotten, because we send out the trade alerts and then after half an hour or so, when the dust settles, then I send out the target. So there are three targets: the first target, second target, and third target. I call it green, yellow, and red target. So there is a green target, there's a yellow target, and there's a red target. And I explain to you in next slide. I will explain what it means if you don't know. And it is also explained in the guidebook, trading system guidebook, so you can read. But I'll explain what is green, yellow, and red mean, and how I define green, yellow, and red, and what need to be done at green, yellow, and red target. So if you have not got filled and you receive the alerts, you receive the message for the target, then just look at the target. Where is the yellow target and where the current price? So when the alert was sent to buy, what was the price of the stock and what is the target? So you will have a pretty good idea that you are not chasing it, this chasing the stock. You have still have a lot of potential. So pay attention to yellow target just for the just to um, um give comfort to yourself that you're not making the wrong decision, and pay attention to the limit price mentioned. So if you look at the yellow target and look at the stock price in the alert, then you may pay a little bit more, like 5 cents, 10 cents. It depends on the option price. So for a $10 option, you may pay extra 30, 40 cents. But for a $2 option, you may pay 5 cents extra. So depending on the option price. So there is a guide I will explain in the next few slides. There is a guide to call to chase or not to chase. So don't chase. Just based on this guide, you can pay a little extra if you think, and don't buy if you have to buy 4 contracts based on your evaluation of something called position sizing or the risk you're taking. So if your system is telling you, your little Excel worksheet or your little notebook and your little calculator on your cell phone, that you need to buy 4 contracts, and if you're paying extra, then maybe you buy 2 contracts by paying extra 5 cents, 10 cents, and then you can buy 2 later on at below price. So your average will come out to be the same. And also one thing, shave the spread. So try to buy at the mid price. So if you see the ask is at 10 and the bid is 960, maybe you try to buy at 980. Don't have to buy at 970, just a little bit tilt towards the ask and you will get filled. So if not, you can cancel and buy at that limit price. So slightly tilt towards the ask because the market maker has to make the money. So if the ask is 10 and the bid is 960, maybe you will get filled at 980 or 990. It's a mid price, a little bit tilted towards the ask. So that's what you do with the limit order. Use limit orders intelligently. And here's the guide to chase or not to chase. So if the option, so sometimes I do send out the small price stocks if it's a fundamentally there is some news there. Some news is there and it's a small price stock. So if it's a small price stock, the options are a small price. I'm not buying the cheapo option on a big stock. I don't do the weekly. I don't buy option expiring in 2 days or 3 days or 4 days. I don't do all that. So I don't trade weekly because I may be right, but I will run out of time, and the sword is hanging on me. So I don't do anything where I feel like the sword is hanging on my neck, and I lose sleep. So I don't do that. So if the option price is low, it means the stock price is low, not because I'm buying 2 day or 3 day of time and just they call it flyer. I took the flyer. So if you took the flyer, you are expecting some kind of major news coming up one way or the other, and you say, okay, I buy the 70 cent option, and if the news comes out positively, the $70 70 cents option will go to like $5. So I don't mind losing 70 cents to make $5. So unless that's the case, I don't do that. So I'm only buying 70 cents or $1 option on a small price stock. So you can pay 5 cents more. So this is just a guideline. If it's trading near 250, 240, then maybe you pay 10 cents extra for a few contracts, and then you can average. You can pay 15 cents for a $4 option. You can pay maybe 20 cents for a $6 option. And if so this option, so $20 option, I don't trade often. On sometimes like Tesla or something. So maybe you can pay 50 cents more. And I don't send trade alerts often to these big price option price trades because I don't know whether the on the other side the members understand what kind of risk they are taking. Their portfolio size could be small, and then they just buy this one contract, $2,000. So if the $2,000 contract turns out to be the winner, so it goes to 3,000. So it's good, $1,000 profit. But if $2,000 goes to $1,000, which is only 50% loss, um, traders don't close the trade because they see the big loss, $1,000. So not the 50% loss. They see the big loss and they don't close. And when they don't close, eventually it expires. So I hardly send high price. If I send, I do mention in the trade alerts that your portfolio size needs to be such and such as 25,000 or $50,000. Only then. So usually the trades are within this range from 2 to 8 or 6, something like that. So this is the guidance for the to chase or not to chase. And another don't be over anxious on partial execution. So there is always a trade. There's always something going on. There's always something. So it's not, and you don't miss. It's not like the alert came 30 minutes later and the stock was a Momo and it was just flying. So I don't do Momo trades. It's all based on technicals, and I see there is something going on, but it's not something crazy based on the volume. So I don't do that kind of trading. So if you entered 4 contracts to buy and somehow it's only you see 2, then don't be over anxious. Or in any endeavor, don't chase anything you're buying. It doesn't matter if it's stock, options, or real estate or whatever. So don't pay extra for remaining contract. It's your bid, so you're bidding. Someone will want to sell to you, so you will get filled. If the trade is correct, you will get filled. If you miss it, you miss it. It means you already missed the profit. it's already beyond your range. So if stock is trading in a range after initial burst, sometimes the burst happens, and you can clearly see on your lower level time frame, and then it subside. So during this subside, you will get filled. If not filled, then you cancel your order. And buy order is only good for a few minutes, and then you cancel it. Never leave it for GTC. So now after we send out the trade alerts, so even before the trade alert is sent, the homework is done with regards to the target. It's just that I have not sent you the target because I just want to send you the trade, and it needs to be properly. There's a lot of things I monitor it. My team monitors also that the trade alerts are being sent properly. It's got delivered to you, and the stock is we have not missed anything. So when you're opening a trade, and even on your own, you have to be suspicious. You have to be vigilant. You have to be also, even though you have opened the trade, you have to look at it if you from the point of view from the other guy. What other guy is looking at, which I am missing out? Am I missing out something? Even though I have opened the trade, maybe I missed out something. So I still have time. So be suspicious, be vigilant. Being suspicious and vigilant doesn't mean that you are timid. So you're not timid, but you're just doing your homework and then properly evaluating the target. So the target, you're not evaluating something conservative. You're not evaluating something beyond the reach. So you're doing your proper work. So we do the proper work. I do the properly identify where the support is, where the resistance is, where the major turning points is. So I go through that, and then I determine the target. So stock target determination is the science and the art. So um, support and resistance, the major turning point based on the intraday level charts. Where is the overbought level? Where is the over sold level? So all this goes on, so that when the stock starts to move in the direction you predict it, it's following the target like a precision guided missile. So do that. So I pay attention. I make sure then I'm sending the proper targets. And if something is happening in the pre-market, then I adjust the target, and I will explain to you. So I call it green, yellow, and red target. So the green target is the first target, the yellow target is the second, and the red target is the third target. So just like a traffic signal. So in the green, when you see the green, you go through. It's like no problem. The traffic signal is green. I can go through the signal. So that's the way I define the green target. The yellow target is you become cautious. So you expect, either you expect that you will cross the other side, or you know you cannot cross, so you have to slow down and take notice. And the red target is just like a red light. You have to stop. So there's a danger. So this is the way the green, red, and yellow and red target is defined. And then there is something I call beyond red target. So this beyond red target happens when the stock gaps up or gap down. So I will explain in detail what is beyond red target. So when the stock gaps up, like Airbnb gaps up or Tesla gaps up or something gaps up, then the target gets revised. So what is happening at the red target? Because if the red target was determined based on some major resistance and the stock gaps above that major resistance, so that major resistance is taken out just like that because of some positive news. So the stock is trading above the resistance. So now you need to revise your target, and you have to hold your position. So that's what I do during the pre-market hours if the stock gaps up. But if there's something else, I let's say I call it a cannonball. A cannonball is fired. So just imagine the red target is like a China wall. So if you go and try to break the China wall with the tennis ball, you cannot break the China wall with the tennis ball. But if you fire some cannons, if you're Genghis Khan and you're firing some cannon, eventually you will create some dent in the China wall and you will go through. So that's what it is. So how the stock is approaching that red target, whether it's approaching with the cannonball or whether it's approaching with the tennis ball. So the volume is there. There's a momentum. There is a positive news. So this some catalyst is there at the major resistance. So when there is some catalyst at the major resistance level, then you may want to hold. So this become tricky whether you expect the resistance to be broken and the stock will move beyond, or whether this is a climax in price or volume and it's oversold. So whatever it is, this is the time you need to close your trades and lock your gain. So when I see something meaningful, I send out either, if it's gapping up or gapping down, I send out the pre-market alert along with the strategy revision of the target. And if it's happening during the market hours, so it's continuous movement, there's no gap up, maybe slight gap, and then suddenly there's a news. So there's a constant momentum there. So I send out the updates on the revision of the target. So the way I define the green target, the first target. So I'll explain to you through some example and the price. So let's say a stock got triggered to buy at, let's say, $100. So $100 stock. So if it goes to 103 tomorrow or 104, so it's a 3 to 4% move. So 3 to 4% quick move very next day or the 2 days later will result in the option, if you buy something meaningful with some time and the delta, 35% gain, depending on how fast it moves, 1 day or 2 day or 3 day later. So because the green target is closer, if the stock is triggering at 100 and the green target is 104, so it's the distance is not far from 100 to 104. So the distance is not far. So when the distance is not far, you have a high probability of hitting that target. I mean, if you buy at 100 and you set the target at 100.05, you will hit immediately. So 5 cents is like within a second, and it can go to 99 also within a second. So just giving some example. But if you're buying at 100 option and then you're setting a 104 target, so the distance is just $4. So it has a high probability of hitting that 104. So it's 95%. So another example I gave you, let's say I'm driving from San Diego to Seattle. So if I start driving from San Diego to Seattle and I put in my GPS and my cousin is waiting in Seattle and I say, okay, cousin, I left 6 a.m. I just left for Seattle. He say, okay, what? So I see GPS was telling me I will reach there in 72 hours. 72 hours drive. So it doesn't mean I will reach Seattle in 72 hours. So that Seattle is a red target. But if I put on my GPS when I'm leaving San Diego, if I put on my GPS LA, it will say 55 minutes. So I'm pretty sure I will arrive in LA in 55 minutes, maybe 56 minutes. So unless I take some exit somewhere. So it's the same concept, 95% probability of me reaching LA from San Diego in 55 minutes. But if I put San Francisco, which is a yellow target, it will say, let's say 7 hours. So I may reach in 7 hours San Francisco if I continue driving, or I may reach there in 4 days. I took a stop at Santa Barbara or uh, Pebble Beach or somewhere. So similarly, so same concept, green, yellow, and red. So if so it depends on how many contracts you have bought. So I give you the green, yellow, and red. So it depends on your exposure. If you're overexposed, you bought more than what you were supposed to buy. Maybe you nibbled and you added more contracts. Instead of investing $2,000 in that trade, you are uh, $3,000 or 3,500. So you can sell some, one third of your position. So it depends, one third of your position at green target. Ideally, if the stock is moving quickly towards the green, ideally you shouldn't be selling at green because you need to maximize your gain. So you shouldn't be selling at green, you should be selling at yellow or red. So always be looking for to maximize the gains. sometimes we do sell at green if, let's say, the trade is triggered at 100 and the target green is a 104, and 5 days gone by and it has not hit the green target. So it just, um, it's just taking its sweet time. Maybe from 100 it went to 96 or 97 or something there, and then it's reversing. And now finally it's coming towards the green target at 104. So you may receive alert to sell all, even though it's at green target, because the number of days in the trade has taken longer. Maybe something else is better. Maybe the option expiry is getting closer. So there may be many variables. So I have a uh, so worksheet. So you need to define your worksheet, a matrix. Need to have a matrix of your cell alerts, yes, triggers. So if this happen, I will sell one third. If this happen, even though it's a green target, I will sell one half. If this happen, even though it's a green target, I will sell all, because some other variables are taking over the target. So don't get bogged down with just the initial target you have defined, because you need to be flexible. So just don't get bogged down that I want to make 30% profit. My objective is to make 40% in each trade, and then you just keep holding, even though the 40% will come after 2 weeks, 3 weeks, already gone 10 days, and you're still holding it. So be flexible. So when we monitor that and send you the alert, either to sell all or half, or the normal is one third. So sell one third at green target. Now there's something we call yellow. Yellow is the second target. So from San Diego to Seattle, I'm traveling. So San Francisco is the yellow target. So yellow target is determined based on some kind of a resistance is there, or some overbought level. Something is there, some turning points. The stock has made its turn before at this price level. So once the yellow target is identified, the yellow target, we call it yellow. And from the example point of view, let's say if we bought at 100, so the green was 104, so yellow could be 107 or 108, which is a 7-8% move. So at 7-8% move, the option will be, it will take time. Sometimes the yellow target can hit, get lucky, and then very next day the yellow target is hitting, it gaps up or something like that. Otherwise, it will take some time for the yellow target to hit. So when the yellow target is hitting, there is a 85% probability of a stock hitting the target. So in other words, when I'm the yellow target is at 108, so the $8 distance, in between $8 distance, the stock can go to move $8 within a day, or 2 days, 3 days, or it can take 7 days, because the distance is far. So it will take its time, but it's going to hit. So if you are confident it's going to hit, then you need to assign some kind of a probability. So the probability defined is 85% of the stock hitting the yellow target. And there is some kind of a pullback you expect. So why I expect the pullback after hitting the yellow target? Because I'm defining the yellow target based on some kind of a resistance. So it's not a strong resistance, but it's like a pit stop. So um, when when we are initiating the trade, when we initiate any trade, we need to look at the resistance distance. Even the how far is the resistance? Ideally, there shouldn't be any resistance above your entry point. So when there is no resistance above your entry point, or if there is, and the stock is moving in a momentum, so that resistance is broken. So the resistance needs to be far, so that you have enough meat in the trade. So if the resistance is, let's say, 109, 110, then the yellow target is 108. So you are entering at 100, you know the resistance is 19, 110, 108 is a target. I can get out and before the resistance. So identify the resistance and categorize it as a yellow target. That resistance is not a major resistance. It's not a very strong resistance. It's somewhere in the middle. So when the yellow target hits, I get notified through my system, and then we send you the alerts. Say we do like that: sell one half or 3/4 of your original position. So if you bought 8 contracts, you sell 4 or 6. So sell half or sell majority, something, these two words, sell half or sell majority alert is sent. Sometimes we just sell the whole position because the yellow target uh, um, took time to hit, maybe 6 days, 8 days. So we don't hold um, beyond yellow. Maybe the yellow target is hitting in a lame fashion. So it also depends how the stock is moving towards the target. If the stock is moving like a cannonball, then the yellow target is will be overtaken, and then it's approaching the yellow target and the red target. So we identify all that, and we send you the alert whether to sell half or sell majority. If his stock hesitates to move up in next 3 days, we sell rest. If we sold half or majority, then I'm constantly evaluating what happened next. Is it moving towards the red, or is it resting, or it has a chance of pulling back? If it's a chance of pulling back, then we send you the alert to sell rest. So sell rest alert is sent to the member. So if you have sold 6 contracts out of 8, then the two contracts you sell within the next 3 days. Sometimes even during the by the market close, we send you the alert to sell the rest. So that is the yellow target. The red target is ultimate target, which is defined based on some major resistance. It's ultimate target. So ultimate target based on the $100 stock could be 112. So there's a 12-point move. So if 112 is the major target, it may take time to reach. So it's like going from San Diego to Seattle. So GPS said 72 hours, but I'm on the road for last 6 days and I'm still far from Seattle. So it can happen like that. So red target. So there is a 70% because the distance is high. So there's a less probability of hitting the red target. So there's a very less low probability of me leaving San Diego and arriving in Seattle in 72 hours. It's a very low chance. So unless I keep driving non-stop. So 70% probability of the stock hitting the target. So red target, the probability is lower, but when the stock gaps up or a cannonball is fired, then I do send out the revised target. So what I do is I determine the new red target. I give you the red target, and the red target, let's say 112. If the stock is trading at 113, then I move the red target towards yellow and the yellow goes to green. And then I give you a new target and I tells you that hold. If you're holding it, continue to hold. Or the way the stock moves, it just hit the red target directly. So if it's hitting the red target, I know you have not sold it at green. I have known that you have not sold at yellow unless you're selling it on your own. So some traders, they just want to make 10%, 15% gain, and they close their option trade, and then they lose 100%. So it's their strategy to make 10%, 15% quick, and lose 100% slow. So I don't do that. So 70% of probability of a stock hitting this target, because it's based on the major resistance, so high probability of a stock pulling back significantly. So in option, if you're trading a stock, the stock doesn't have time value, so it's not losing any time. But if you're trading options are meant for hedging or speculative purposes. So don't uh, put your what is it, your thesis, let the profit run, because in option not designed for let the profit run. I know some stock, they just keep going, and then the 50% profit can turn into 200 and 300. So it happens. So you have to know your average gains. Where is the average gain? So that's what you're looking for. Sometimes it's just gap up and or gap down is you got lucky. But on average, where is the way you design your red target, either at support or at resistance? So we send you the alert sell rest. If we know that we have sent you the majority alert or the half alert or 1/3 alert, so based on what we have sent you before, we send you the alert to sell rest or sell all. So sell all or sell rest. So these kind of alerts are sent to you during market hours. So now, so I'm teaching you what if how you can maximize the gain. That's the purpose of this session. So how you can maximize the gain by following the trade alerts. So action to take at red target. So if you're watching your red target, if you know this is a red target, so what is happening at red target? Then you so even if you're trading on your own and you know that you're defining your target based on some major resistance, or if you're trading short, then at a major support. So something has to be there, either a major support or major resistance for your red target. So if you have defined your resistance and support correctly, so again, what you're defining as a resistance may not be a resistance there, because it's you who defining it. So there are millions of traders, they're defining their target resistance level differently. It may not be true, or it may be true. So if you have defined that this is the red target, and you have a skill in identifying the target, so that the stock, if it's gapping above that resistance level, it means all the sellers are taken out, just like that. So the meaning of resistance is what? It's the supply zone. It's where the suppliers are, the sellers are. They are caught in their position. They went long um, in that stock, and they have been holding it. So there was a lot of action. The buyers turn into sellers, or the seller turn into the buyers. So there is some price level there is a supply. So that's where the resistance is. There is some kind of a huge supply at some price level. So that is the red target. So if the stock goes above that supply level, supply zone, the support is called the demand zone, and the resistance is called the supply zone. So if the stock gaps above the supply zone, so all the sellers are not sellers anymore. They are holding their position, and because the resistance is taken out, so the other traders, they also know that this was the resistance zone. They were waiting for it, and now they know that they also need to get in the bandwagon. So there's a new demand gets created at the major resistance if it's taken out, and the resistance is taken out in the form of a gap. So if the stock is gapping above, there is some news, and there was a pre-market action. So it's important for us to know what was happening. If the stock is gapping up, it's important to know what was happening in the pre-market hours. That's why it pays to wake up a little early and see the high and the low of the pre-market and what kind of action was it. So if there is a movement going on in the pre-market and there is some volume, so you need to know the pre-market highs if you are in the long position. So you need to know the pre-market high. So if the stock is gapping above the pre-market high and the volume is there from the get-go, and that was a resistance. So let's say you define a line and say, okay, this is a resistance 112, but the resistance is not just one price, it's a zone. So let's say between 110 and 112 is a supply zone. This is where the sellers are, and the stock gaps up and is trading at 113. So now the line in the sand is 110. You know the supply zone is 110 and 112. Your line in the sand is 110, and you were willing to sell at 108 because or 109, because the supply zone was 110 to 112. Now the stock is trading at 113, 114. So now you are lucky. You have some leeway to hold that position, because now you are beyond your profit target. So stock gaps above the red target, and it stays above the red. So if the red was 112 and it's trading at 114.15, you hold it. It's safe to hold. And if it breaks below red, so let's say it was red was 112 and it's breaking 111. It depends on your personal also situation, how many positions you have and how many contracts you have. You may sell 50% or 100% or whatever you have to sell. So I do set out the target, but it also depends on I don't know what your situation is in your portfolio. Sometimes I do send the alert to sell immediately. So um, the stock is gapping up in the pre-market, I can see, and during the first 15 minutes, it's very hard to watch the action in the stock during the first 15 minutes, whether to hold or to sell. So during the first 15 minutes, the stock maybe sharply moving down. That gap up is not, um, it's just temporary. So I send you the alert via SMS and email to sell all. So you sell all. If the stock gaps up, and I know that stock is going up, then we revise the red target and we send you the red target. So we first alert I usually send out to hold, just please continue to hold. That's the short message you receive via text and email. Please hold this. So you hold, you don't sell. And if you're trading option during the first 15 minutes, sometimes the market maker has not even opened the option market. So the market, the stock is trading volatile, but the option, you look at it and is not trading, because the market maker has to make sure that he is not losing the money on this trade. He knows, the option market maker knows that this stock is gapping up and he needs to take care of his books, and then he opens. Sometimes the ask is you know the ask is flying through the roof and the bid is way below there, so there's a big spread, and you say, what, I cannot sell. So you cannot sell at the market price. You will get filled at a big crazy price. So be careful. So markets are dynamic, traders need to be flexible, and there are various reasons to revise the red target. And the red target is revised to capture more gain. So all this is being taken care of, or look at what is going on in the option market. Where is the stock landing on a day chart? What kind of news is there? What kind of volume is there? Where is the resistance and whatnot? How much gain we have? How many days we have been holding this trade? How many days left in the expiry? So you see, so many variables. All these variables are analyzed, and then we send you the alert in the real time. So revision of targets. So targets are adjusted upward for calls. So we constantly, if we see the potential, we adjust the targets to the upside for calls. And sometimes the targets are also adjusted to the downside. So initially we thought the stock triggered at 100 and yellow is 108, but it's not 108. It's just dwindling at 106. It just goes to 106 and it pulls back to 105 or 104. Then it goes to 106 and then it pulls back to 104, 105. So that 108 yellow target is no longer valid. It's just 106 now. So we get we sell. So we adjust. Sometime we revise the target to the downside. So you may see a down arrow next to the target. So we put a down arrow. We say, okay, this is a target getting revised to the downside. If we revise it upside, you see the upward arrow. So you know the targets are revised to the upside. Same for puts. First target price is replaced by the second target price. So the yellow target becomes the green target and the red target becomes the yellow target. And then we give you the new third target, which is the red target. And the target may also shrink. So when the target is shrink, sometimes we just close it at break even or loss to close the trade. And sometimes the trade has just, the sentiment has changed. It was a short, and the way it's moving, it's no longer a short. And not only that, but it has turned into a long position. So when you can switch your trade, when you identify this, you have the opportunity to not only to cover your loss, but to make turn it into a profitable trade. It's the same symbol. It's hard for a trader to reverse the position when you just close the trade in a loss, and now you are opening the trade on the other side. So it's hard mentally. So but you have to realize that okay, this trade is no longer valid for the short. It's actually turned into a long, or this trade is no longer a long. It's actually a short. So when that happens, you close the trade, and you may want to open the trade on the other side just to make sure that you don't lose on the other side also. So that's not good. So here I have a complex matrix which I developed over the time. But these are so there are a lot of variables behind the triggering of the alerts. So, but these are the terminology I send you. Selling 1/3, which I send usually when green target is hit. Selling half, which I send you when the yellow target is hit. Selling majority, I send you when the red target is hit. And if I send you the selling majority or selling half, then I'm sending you the alert to sell rest. So it's normal. Based on one of these, I send you the alert to sell rest. Or if I have not sent you any alert and something happened and I see the target is hitting and it's time to close, so we sell all. So let's say we are holding Carvana calls, 9 days gone by, and 9 days gone by, and we are up on the 18%. So I know I have not sent you selling one third. I know I have not sent you selling half or selling majority or selling rest. So 18%, 9 days gone by. So we just close the trade, take that 18%. So I send you the alert to sell all. That's one thing. Another thing I do is this, when the stock is moving dynamically, is moving like crazy, and there's a spread there, 60 cents, 70 cents. This, let's say it's a Tesla. So if it's a Tesla, I give you a range of option price. So I give you the range of options. Sell this contract between 10 and 10.50. So I give you the range, and then you sell it between 10 and 10.50 because I know that the stock is moving. And if you set in between 10 and 10.50, you will be taken out. Another sometime it happens, I give you this alert: sell to close by market. So this happens when the stock is moving and it just keep going, let's say, and it's profitable. So, and it's Friday or a long weekend, something is happening. So then I send you the alert to sell to close by market. So it's constantly moving up. I send you the alert to sell to close by market. So 5 minutes before the market, if you're able to watch the charts, if you are dedicated trader and you are monitoring your charts, then you can take action to close by the market. If you cannot watch, you're just operating out of the phone, then you close it when you receive this alert. You don't need to wait by the market. So now this is also very important. If you have an open position, you need to wake up a little early and see um, what is going on in the pre-market hours, which positions are moving in your favor and which position is not moving in your favor in the pre-market hours. So, or after market hours, some news, some earning is there, or during the pre-market hours, some news is there, which is not earning, is some news is there. So during the pre-market hour, which is called non-regular session, you need to know if the red target is hitting. If it's hitting, then find out the high price. A lot of time, if you have defined your resistance, your red target based on some major resistance, so that major resistance is, if you're reading it correctly and the stock is moving up in the pre-market hours, then that resistance is also working in the pre-market hours. It's not that that resistance is only valid for a market during the regular session. So if the stock is moving and somebody has a lot of stocks to sell or a big position, they will sell in the pre-market hours or after market hours. They will be exiting during the non-regular session. So the high made, if let's say if it's a long position, the high made is the ultimate high, and that high will not be um, you will not see that high during the regular session. When the market opens, maybe, so if the high was made at 112 during the non-regular session, let's say pre-market hours, when the market opens, it opens at 110 and it never goes to 112. It opens at 110 and then it goes to 109. So it happened on Amazon. So I tell you, we bought Amazon calls just last week before, yeah. And then during the aftermarket hours, it hit 112, 122. It hit 122. And we went long, I think, at 105, something like that. So many stocks, so many prices. So it went to 122 during the after hours, and that was the high. And it starts to pull back, pull back, pull back. So if, and it, it's still trading somewhere 107, 108. We are still holding Amazon calls. So that can happen. The 122 hit during the aftermarket hours, and boom, 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 it just fell. So we are still holding Amazon calls, not profitable yet. So that 122 is a major resistance for Amazon. So the stock can hit the major target during pre-market hours or after hours, you need to be aware of that. Some event has occurred, so earning news or FOMC or something. So if the high has been made at 122 during non-regular session, that high must cross during the regular session. If it's not, then you know there's a problem with that stock. The stock must gap above the red for calls. If the red was let's say 112 and it was trading at 113, 114 during the non-regular session, and then when it opens during the regular session, it's trading at 109, etc. So you know that okay, the high was made in the regular pre-market hours, and you need to sell your calls when the market opens because it's not going beyond that. So red target is defined and such that it should continue above. It should continue its journey. And the pre-market alert and strategy is sent to members. So I monitor the pre-market hours, all the open position, and see the target where it's trading, and I adjust the target and I send you during the between 6 a.m. and 6:30 a.m. before market opens. I send you the revised target. So now, I also send you the alert if you should be holding. So when we are holding a position, to what we can do to maximize gain, we can simply add to the existing position. So you can add to the existing position. It's a good strategy. If you bought, let's say, you're holding July 230 calls in Meta, and is moving up, you may add more to the same July 230. You may, so it depends on if you have a profitable position. If you have a profitable position, you can sell that 230 and buy the 235 calls, or for the same month, let's say July, or you can buy the August month, you're buying more time. So new strike, new month, same strike, same month, or a new strike, same month. So there are various combinations you can do to maximize your gain, or you can simply sell the short. You can sell the short, the strike, and create the spread. So now you have locked your gains and you created a spread. So there are many ways to maximize the gains. So um, you need to know what will happen and what you will do. What will trigger what? What kind of a strategy you will adopt when the stock is moving in your favor. So you may have options, you just don't want to buy options, you just keeping it. You may buy 100 shares, 200 shares, depends on your portfolio. You just don't want to create any option position, but you want to buy shares, so you can do that. So many things. If there is any news, I send you the update on the news. I send you the technical analysis, something going on, I send you the alert from the technical point of view. Volume, if the volume is picking up and it's meaningful, something going on with related to volume, I send you the update. And I'm constantly sending you update related to the targets, whether to sell half, sell one third, or get ready, or sell by market, sell at this range, etc. Sometimes we buy more. So I do believe in averaging it down. People say never, 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 never average down a losing position. So I don't believe in it. So again, it's my belief. So what you're seeing, what I have explained to you so far is my belief in related to trading. Your belief may be different. So when my belief or any person's belief you're following and matches or align. So if you're following me and my belief and your belief matching, then you can follow. Otherwise, you say, no, my belief is that I don't buy, I don't add to the losing position. So I add more to the losing position and to the winning position. So especially to the winning position. So, but don't add to the winning position at the high. Don't add to the losing position just for the sake of averaging it down. So people average down willy-nilly. Don't do that. If you're averaging it down, there must be some criteria, some catalyst, whether it's something is happening, which is some evidence is there which tells you that it's time to add, whether it's a reversal from the support, whether there's a breakout, whether there's a news, something is there which is telling you that you need to add. Just don't add to your existing position to bring down the average cost. So that's not the right strategy. I receive emails saying, "Hey, no, I bought at 10, now it's trading at 940. Should I buy more?" So ask yourself, if you bought at 10 and it's trading at 940 and you buying more, so what you are achieving? What are you trying to achieve? Bring down your average cost by 20 cents. It's not going, and you're increasing your risk so much and bringing the cost down by 20 cents. So don't do that unless mm, you can buy. If you bought at 10, you can buy more at 11, but know that you're increasing your average cost, but you have a reason that this is the winner position. You need to add to the winning position. So you may not buy the same strike July 230, you may buy July 235, you may buy August 230, or you may add 100 shares, something like that, to buy more. So when this happens, I do send out the alert to buy more at the high price and buy more at the lower price. And the reason to buy more at the high price, and sometimes I send you the alert to buy more because there are always new members in the list. So I say like this: if you have existing position, you can even if you have this position is open, let's say at $10. Now it's trading at 11. You can still buy more at 11, or if you don't have a position, you can buy at 11 is good, even though our original position is 10. Or it's we bought at 10 and it's trading at 6, so you can buy more if you already have at 10, so you buy more. And if you don't have, then you are lucky, you just join, and it so happened we are sending you the trade which we originally we have at 10, and I'm sending you alert to buy at 6. So all this is in the alert. So that open date, you can see when the original trade was open. So we specified the date and the time stamp to the minute, to the second. So date and time is listed on the trade when the trade was open. So you do that. Another thing I need, this is a different topic, but I'm just mentioning it to you, the conditional order. So you should know the conditional order. So conditional order is the conditional order means that some condition is triggered, some buy order or some sell order is triggering because of some condition. So condition is could be that you bought the calls, Meta calls, let's say July 230 calls when Meta was trading at 230. So the target sent at 240. So although I give you the estimated option price at the various stock target, at one target, the yellow target, I estimate the option price, what will be the option when the stock Meta hits 240. So I do that, that's the estimated. So and that estimate changes because of the variables in the option formula. So you cannot estimate 100% correctly what would be the option bid or ask when the target hit is just an estimate. So you can set the conditional order based on the target. So if the target is 240, it doesn't, and that 240 is determined based on some resistance level. So it doesn't matter if you bought the Meta at $10 and 240 is hitting, that option may be trading at 11, it may be trading at 12, it may be trading at 20. You don't know. The option price you calculated based on everything going smoothly. Everything is going smoothly. But if that trade has taken time, even though the target is hitting 240, which is a major resistance, the option is not there. It may be trading at 11. And then if you have set the 40% profit objective, and I want to make 40% in the trade. So if you set 40% of the trade, if you bought at 10, you would set at $14. But if the Meta took 10 days to hit 240, that 40% is not there, is 30% or 20% or 10%. So ideally, you should be selling your option trade based on the stock target, not your predefined some kind of a objective on the option, because there are so many variables. You're reading the chart of the stock, you're trading options as a vehicle, but you're actually trading the stock. So don't so be careful. Do the target determination of the stock. So something in your brokerage platform you can set called conditional order, or it's called activation rule also. So you can say that when Meta hits 240, sell my one contract or sell all of my position at market. So there is a little problem there. Your order will stay with your broker, and it will get activated when the stock is hitting that it will become a market order, and whatever is the price at that time, it will get executed. So this conditional order works good in a liquid market where the spread is very tight, and it's a liquid market, the spread is very tight, and there's a lot of activity going on. But if the spread is wide, there's not much option. You are the you read the stock correctly. Sometimes I do buy it, and people send me alerts saying, "Hey, there is no open interest or there is no option volume. Why are you sending me this trade alert?" So maybe I'm the lone wolf. So I don't sell that option based on the market. I don't sell that option based on the conditional order. I have to sell that option based on what I'm seeing at that time. So that's where the conditional order doesn't work on a illiquid market. Is it because you will be getting out at not at a good price. So something you need to look at. You can set the conditional order based on anything. You can set the sell my Apple call based on Baba. Sell my Apple calls when Baba hits 200, or sell my Apple calls when Meta hit 300, or sell my Apple calls when the Nasdaq hits this level, or S&P hits this level, or sell my Apple call based on the when the market is about to close. So you can set many conditional orders, and you can create multiple criteria. So it can be a complex sell orders, conditional sell orders. So for simplicity's sake, just set the sell order based on the stock target. So this is something you can do when you cannot estimate the option price. The option price can be estimated correctly when it's coming closer to the target. So if Meta is trading at 239 and the stock target is 240, it's easy to determine the option price because there's only $1 difference. But if the Meta is trading at 232 and the stock target is 240, is you can estimate your option price, just an estimate. Plug in the numbers on the option formula, and you can come up with the estimated price based on this stock target. But that's just estimate. So this is what I do. I send you the trade alerts during email and SMS, and I'm sending you constantly the updates. Sometimes we don't send the alerts with the stop. So and there is a reason for it. If you're buying an option at $2 or $3. So when you're buying an option at $2 or $3, and people do set the alert saying, "Hey, $2, I set the alert stop loss at 25% or 30%." So that $2 option can go to $1.50 immediately, can go. So 25% move, and then you're out, and then the $2 option goes to $3. So in you're trading the stock, you're not trading, you're using the option, but you're trading the stock. So there has to be some leeway, some conviction that your trade will work. So in the options, if you put the stop, the stop works on a higher price option. So if you're buying at $10, then you can say, okay, I can $5 move. If the option goes to $5, it means the stock is not moving in my favor, and I'm out with $5 stop loss. I bought at $10. But if you're buying a $20, $2 option or $3 option, and you're setting at $1.50, you will be taken out again and again and again, and it will cause you stress. So the stop triggers based on what the stock is doing, and it's doing something unexpected. Some kind of unexpected move is occurring, not just because it dwindle 50 cents one day, then it dwindles 70 cents next day, and your option is trading at from $2 is trading at $1.40, and then you're out, and then next day it goes to $3. So that's why in my trade initially I don't send. You can set the alert at emergency. I give you the stop at emergency level, but the options are not meant to be traded with the stop unless you are buying a high price option. It's, so you need to have some conviction when you're trading. When you trade, you have some conviction that this trade will work. It will take time, but it will work. When you see it is not working, that's where you sell. So just don't set the stop loss quickly, 30, 40, 50%. You will be taken out immediately. In a little move to the other side and the option goes uh, 50% loss. So in option trading, the moment you open a position, you are at loss, and the reason is there is a spread. So the market maker is making money, you're losing money right away, 10%, 15%. The moment you buy option, you're losing. It's like you buy a new option, is like you buy a new car. You buy a new car, you get out of the parking lot, you lose 25% of your car value. So just like that, the moment you buy an option, you lose immediately because of the spread. Then they could be the volatility could be high, and then the volatility subside, the option price goes down. Maybe the market maker fool you. He put some bid, you didn't pay attention. The bid was this, and the ask price was this. And he created a narrow spread, and you thought it's all right. And what he did, you immediately you bought. The bid remains the same, and the bid goes down and the ask goes down. Something he did, and he brings the option price. Now suddenly you start losing. Some news comes, and the stock tanks 1 or 2 points, and then the $2 option goes to maybe $1.20 or dollar, and the very next day, third day, the stock goes up. So all this thing is happening. So when you're trading this option, the risk you're taking as if you're going to lose 100% in that trade. So when you initiate a trade, you assume that you can lose 100%. So when you lose, when you put the dollar amount accordingly. So the risk could be 1% of your portfolio, or it could be 2% of your portfolio. So if you lose, it will hurt you only 2% of your portfolio or 3% of your portfolio. So initiate the trade based on as if you're going to lose 100% in that trade. It can happen. And option is designed that way. It's either for speculative purposes or for hedging purposes. So don't apply the stop loss formula of stock trading into option trading. It for me, it doesn't work. So that's all. And I will hold another session with another topic next week, and you will receive the notification. And if you have any question, please send us email. Please send email to success@TradeGenie, and we'll be happy to answer. All right. Thank you. Bye.